The internet was supposed to change everything, and it did, just not in the way anyone expected. In the late 1990s, the world fell in love with the idea that the internet was the future, that any company with a website could become the next billion-dollar empire, that the old rules of business no longer applied. Investors believed it, banks believed it, governments believed it, even ordinary people believed it. So they poured money in, billions of dollars, into companies with no profits, no revenue, sometimes no real product at all, just a domain name and a dream. For a few years it worked. Stock prices soared, paper millionaires were made overnight, the economy boomed, and then it all fell apart. In less than 2 years, over $5 trillion in market value was wiped out. Companies that were worth billions became worth nothing. Jobs disappeared, savings vanished, and the world learned a brutal lesson about what happens when hype replaces reality. So here's the real question. Was the dot-com crash just a market correction? Or was it one of the most destructive financial manias in modern history? In the next few minutes, you'll understand why investors abandoned every rule of rational investing, how billions were poured into companies that never made a single dollar of profit, which companies collapsed completely, and which ones somehow survived, why the warning signs were ignored until it was too late, and what the dot-com crash still means for markets today. This isn't just about tech stocks. This is about what happens when the world bets everything on a story. Let's begin. The birth of the bubble. To understand the crash, you have to understand the excitement that came before it. The early 1990s brought the World Wide Web to the public. Suddenly, anyone could build a website, anyone could sell online, anyone could reach millions of people instantly. This was genuinely revolutionary, and the business world noticed. Entrepreneurs started building internet companies at a staggering pace. Online retailers, search engines, news portals, pet supply stores, travel booking platforms. Every industry was being disrupted. Every old business model was supposedly dead, and investors desperately wanted a piece of it. There was just one problem. Most of these companies had no clear path to profit, but in the late 1990s, that didn't seem to matter. The new rules that weren't rules. For most of financial history, investors followed a simple logic. A company is worth something if it makes money, revenue, profit, cash flow. These were the foundations of valuation. But the dot-com era introduced a new vocabulary: eyeballs, market share, first mover advantage. The argument went like this: profit doesn't matter right now. What matters is growth. Grab users, grab attention, dominate the market. The profits will come later, and investors accepted this completely. Companies were valued not on what they earned, but on what they might earn. Someday, maybe, a startup with no revenue could go public and be valued at hundreds of millions of dollars, simply because it had internet in its business model. This was the logic that fueled the bubble, and it was deeply, dangerously flawed. The money machine. Between 1995 and 2000, something extraordinary happened on Wall Street. IPOs, initial public offerings, became events. When a dot-com company went public, its stock would often double or triple on the first day of trading, regardless of the fundamentals, regardless of the business, just because it was an internet company. Venture capitalists were throwing money at anything with a .com in the name. Companies were burning through cash at rates that would have been considered insane in any previous era. This was called the burn rate, and many companies wore it like a badge of honor. Spending fast meant growing fast. Growing fast meant winning. At least that was the theory. Meanwhile, advertising money flooded into internet platforms. Traditional companies panicked. If they didn't go online, they'd be left behind. So they spent too. Everyone was spending. Nobody was earning, and the stock market kept going up. The famous failures. Nothing captures the madness of the era better than its most spectacular collapses. Pets.com raised millions of dollars to sell pet food online. It had a famous sock puppet mascot, a Super Bowl advertisement, national brand recognition. It went public in February 2000. By November 2000, it was gone. It had spent more money acquiring customers than it ever earned selling to them. Webvan raised over $800 million to build an online grocery delivery empire. It expanded aggressively into multiple cities before proving its model worked in even one. When the money ran out, it collapsed, taking thousands of jobs with it. Boo.com tried to build a global online fashion retailer. It burned through $188 million in just 6 months. Its website was so technologically advanced that most computers of the time couldn't load it properly. It went bankrupt in 2000. These weren't small operations. These were companies with serious funding, serious press coverage, and serious investor backing. They failed because the foundation was never real. Growth was the product, and growth alone cannot sustain a business. The warning signs nobody heeded. Here's the uncomfortable truth. The warning signs were there. By 1999, serious economists were raising alarms. The NASDAQ, the stock exchange dominated by tech companies, had risen over 400% in 5 years. That kind of rise had no historical precedent. Warren Buffett, one of the most successful investors in history, refused to invest in dot-com stocks. He said he didn't understand how they would ever make money. The market called him old-fashioned, out of touch. Alan Greenspan, the chairman of the Federal Reserve, had warned as far back as 1996 about what he called irrational exuberance in the markets. The market ignored him too, because when a story is powerful enough, people stop asking whether it's true. They just want to be part of it. And that is exactly what makes bubbles so dangerous: the collapse. The peak came in March 2000. The NASDAQ hit an all-time high of 5,048. Then it started to fall, at first slowly, then faster, then catastrophically. By October 2002, the NASDAQ had fallen to 1,114, a drop of nearly 78% from its peak. Trillions of dollars in wealth erased, not shifted, not transferred, simply gone. Companies that had been worth billions were delisted, dissolved, or sold for parts. Many of the executives who had been celebrated as visionaries quietly disappeared. The employees who had taken stock options instead of higher salaries lost everything. Ordinary investors who had poured their savings into tech stocks watched their retirement funds collapse. The human cost was enormous. The ripple effects. The crash didn't stay on Wall Street, it spread. Hundreds of thousands of tech jobs disappeared. Cities like San Francisco, which had boomed during the bubble, entered sharp economic downturns. Advertising revenue collapsed, taking media companies down with it. Then came September 11, 2001, which deepened the economic uncertainty even further. And then came the accounting scandals: Enron, WorldCom, Global Crossing, companies that had used creative accounting to hide their failures during the boom years. When those frauds were exposed, what remained of investor confidence crumbled. The economy entered a recession. The Federal Reserve slashed interest rates aggressively to prevent a deeper collapse. Those low interest rates, held for too long, would later contribute to the next financial crisis. But that is a different story: the survivors and what they had in common. Not every dot-com company failed. Some survived, and their survival teaches us something important. Amazon was nearly written off during the crash. Its stock fell from over $100 to under $6. But it had a real product, real customers, and a founder who kept building. It survived. Google launched in 1998 and had a clear business model built around advertising tied to search intent. Real revenue, real growth. It survived. eBay connected buyers and sellers in a way that generated genuine transactions, real commerce. It survived. The companies that made it through had one thing in common: they were solving a real problem for real people, not just telling a good story. That distinction, ignored during the boom, became everything during the collapse. What the dot-com crash still means today. The dot-com crash didn't kill the internet. It killed the illusion around it. And in doing so, it reset the entire industry. The survivors built stronger, leaner companies. They focused on revenue, on unit economics, on sustainability. The crash also became a permanent reference point. Every time a new technology attracts massive investment and sky-high valuations, the question comes back: is this another dot-com bubble? It's a question that gets asked about social media, about cryptocurrency, about artificial intelligence. Sometimes the comparison is fair, sometimes it isn't. But the fact that we still ask it tells you everything. The lesson from 2000 was not that the internet was a fraud. The lesson was simpler than that. Hype can drive prices far beyond what reality can support. And when reality returns, it returns fast. The dot-com crash was not just a market correction, it was a full collapse of a collective delusion. The belief that a new technology could suspend the basic rules of business. That growth alone was enough. That profit could be deferred indefinitely. It couldn't. It never can. The internet did change the world. If you want more breakdowns like this, no noise, no hype, just the real story behind the events that shaped the world, subscribe now, because the next financial shift you need to understand is already underway.